So if you've tuned into the Texas Water Journal webinar, we are just about to get underway. We're going to give a few more minutes for people to go ahead and log in, and then we will get started.
Todd, I think the other thing we can do, if it's a little bit troublesome to get all the screens split with everyone on there, people will still be able to submit questions in the Q&A part. And, you know, as far as format for all of the listeners, I view this as being something that's done in the appellate court style. And what I mean by that is if you imagine me, a lawyer, up making a case before you, the judges, you can literally start interrupting me and if you're so inclined, and that's completely fine. We'll work those questions in and handle them on the fly because there's more than enough content here to talk about for the allotted time. But to the extent that we can really focus it on the things that are foremost on some of your minds, I'm very happy to tailor things that way.
Okay, that sounds good. Well,
and so
go ahead.
Yeah, as I say, if you'd like, if you want to introduce the Water Journal and the series, and then I'm happy to just launch right in.
All right, everyone. As you can see, I'm a novice at Zoom still, and that's because this is only our second webinar for the Texas Water Journal. I'd like to welcome everyone today. And before we get started, just a couple things about the journal. First of all, hopefully you've seen the journal at some point. If not, it is free to subscribe to the journal. We publish completely online. The Texas Water Journal is a 501c3, and we have a variety of different articles that I'll go through here in a moment. It takes a lot of people to bring the journal to you. Here they all are. You can see more about these folks on our website. Just go to texaswaterjournal.org. We have 4 general types of articles: general research or issue articles, and we've got book reviews, commentaries, and then we have something called research policy program or legal reviews. And occasionally we have Texas Water Journal forums where we get folks together who are experts on certain water issues and have a panel discussion, which we videotape and then put on the Texas Water Journal website. We also produce, with the Meadows Center for Water and the Environment at Texas State and the Texas Resources Institute, a publication called Texas Plus Water. And occasionally we produce special products for organizations such as the American Water Resource Association. We produced this special issue on Texas water issues for them last summer. And once everybody can get back together again safely, we're going to resume this, the Texas Water Symposium, which we're about to do this spring with the Hill Country Alliance, Texas Public Radio, and UT San Antonio. So that brings us to webinars. Our webinars are based on our recent articles, and we do appreciate you paying the registration fee. That goes to support the journal for paying webinar, Zoom, and other costs like that, which since everyone's a volunteer at the Water Journal, we normally have to pay out of our own pockets. And today we are very pleased to have Gabriel Collins, who's the Baker Botts Fellow in Energy and Environmental Regulatory Affairs at the Baker Institute for Public Policy's Center for Energy Studies at Rice University. His research focuses heavily on water, including the food-water-energy nexus, water valuation, water governance, and oilfield water management, as well as unconventional oil and gas, and a range of environmental, legal, and national security issues. Collins is a Permian Basin native who received his BA from Princeton and a JD from the University of Michigan, and he is licensed to practice law in Texas. And Gabe has told me he'd really like to make this an interactive presentation. And so I'm going to figure out how to allow everyone to ask questions, and I'll turn it over to you, Gabe, and you can kind of describe how you'd like to do that.
Sure. Thank you, Todd, and I appreciate you having me here today, and I appreciate all of you in the audience who have taken the time to be with us. I think if many of your professional lives and personal lives, frankly, as well, have been anything like ours, you realize that the coronavirus in some ways has almost made us more busy. And so really appreciate you taking the time. As far as format today, what I anticipate doing is giving a brief overview of the hydrovascular grid concept, where this idea originates and why I think it's applicable in the Permian Basin oil field, especially on the Texas side of the border. We can certainly as well talk about some of the benefits and challenges. And then I suspect what many of you will be interested in, and it's certainly an interest area for us as well, is how does this concept and some of the things surrounding it potentially change given these uncharted market waters that we're in right now and some of the dramatic and very high velocity impacts that that is having on the oil field. And while I'm talking here, if you have questions, even before we get the interactive part set up, feel free to type those into the question and answer area, and I'll do my best to answer those on the fly. My general policy is almost nothing is taboo. If you insult my family, we might have a problem, but other than that, it's pretty wide open. And so, by all means, we'd welcome you to avail yourselves of that. So I guess without further ado, when we talk about the hydrovascular grid concept, this draws on some legislative discussion that was originally initiated by Representative Lyle Larson from San Antonio during the 2015 legislative session. And the vision that he was articulating at the time was, I think, much more on the municipal water supply side, perhaps also industrial and agricultural, where you're imagining kind of a blood vessel system of water conveyance and supply infrastructure crisscrossing the state of Texas. And obviously you could see the appeal of this, particularly if you're in one of the drier parts of the state during a drought period. But, it's something that just in terms of scale and cost and logistics would be enormously expensive and complicated to implement, but it's nonetheless very thought-provoking. And one of the thoughts that came to my mind as I looked at this idea again last year was, well, maybe we're not ready for this on a statewide level or even a regional level in many instances on the municipal water side. There was one part of the state that struck me as having a lot of these prerequisites already in place, and that's the Permian Basin oil field. You already had a vibrant spot market for water being sold to supply fracs. You have a volume of water that's generally a significant multiple of the amount of barrels of oil you're producing that's coming back up out of the ground as produced water that you have to find something to do with. And there was very significant engagement by capital providers, a lot of E&P companies putting their own capital to work, and just this veritable beehive of activity. And then on top of that, when you looked at how people's systems were being constructed and where they were being constructed, you can see that it's an environment that is ripe for various kinds of interconnection and creative management of water systems in a way that would more closely mimic what we see in more established commodity markets, oil, refined products, and natural gas, for instance. And so that's what really launched this research. And the bottom line is, as I started digging into this, and granted, this was in 2019 when we were in a very different market environment than we are now, but as you could see huge potential when you looked at how, for instance, Company A and Company B might have water systems that in some cases have assets almost within a stone's throw of each other. One, as you see right there, there's probably duplicative investment of capital, but also you see an enormous amount of potential for being able to interconnect those systems so that you can better manage various types of swings across the system. Perhaps you have a saltwater disposal well go out in one place and maybe you have available capacity in another. And if you have all of your systems set up in a balkanized individual way, it's very hard to optimize for those types of scenarios unless your system is truly enormous, which in some cases is exactly what we have. But in many cases, you have kind of this island of smaller systems that, looks sort of like the former Yugoslavia when it broke up after the Iron Curtain came down. And that's far from the most efficient way of being able to operate, particularly when you look at this emerging oilfield water ecosystem from a very high level perspective of not just capital optimization, but also operational optimization. And now that we're seeing more issues emerging with seismicity, if you have greater interconnectivity between systems, it potentially also gives you some more options for managing those types of contingencies without disrupting oil and gas operations, as you do so. And, when we think about kind of how this grid system would start to get implemented, I think one natural pathway, and it's one that we've already seen quite a bit happen on the ground, is through consolidation by large, well-capitalized entities that come in and start rolling up existing system footprints, and in some cases building additional infrastructure, both in terms of high-volume pipelines to connect some of those existing systems, as well as expanding off of the backbone you're creating. I think two of the entities that really stand out here, one would be NGL Energy Partners and the other would be WaterBridge Resources. And the Delaware Basin has been an epicenter for this activity. I think a big part of that is because the water cuts are generally substantially higher than they are in the Midland Basin. So it makes it more attractive if you're coming in as a water-focused investor. But kind of moving north to south, we've seen NGL engage in significant consolidation activity in the northern Delaware Basin, both in New Mexico and then the Texas-New Mexico state line area and points a little bit further south. And we've seen WaterBridge do very similar things, largely in the area south of Interstate 20 down to almost Interstate 10, where many smaller systems are being rolled together and consolidated into a larger corporate framework. And my suspicion over time is the consolidation won't just be at the corporate level. That, we're already starting to see pretty strong signals that it's happening at the operational level as you acquire the ability to consolidate and optimize some of your flows. And I think that's something that we would have seen continue even under the more benign market conditions that we had pre-coronavirus. But some of these things, I think, in certain instances, some of these trends may actually accelerate given the challenges that we're now facing in the market. And so as we think about some of the recent market evolutions, I think one of the things that we're discovering, very rapidly and very viscerally in real time now is that anybody who's in the oilfield water business is fundamentally a long-dated crude oil trader, and even heightening that they're long-dated crude oil traders that don't have the same ability to hedge as somebody who is just producing oil and gas, where you can go and there's very liquid, highly traded futures contracts that you can use to lock in your cash flows and stabilize your broader financial picture and kind of insulate yourself against macro turbulence. That's not the case on the water side. We unfortunately don't have a NYMEX produced water contract at the moment, and we probably won't anytime soon. It's a very different type of commodity because it's become a commodity, but it's one at this point that has very limited end use markets. Basically, the end use markets now are either put it down a disposal well for a fee, or to the extent that there's completions activity going on, you can clean that water up and resell it back into the oil field fracking market. But, when you have local prices in the neighborhood of $20 to $25 a barrel, and in some cases significantly less, that market really dries up. And so it becomes extremely challenging. I think we've seen this already. If you just look at the anecdotal data, and you see that at many of the water-focused service companies, even very senior people are being furloughed and laid off at the moment. I think it gives you a pretty good proxy for just how tough things have gotten in that market. And this is likely to endure, I think, for quite some time. I think one of the things that makes this grid concept interesting is there was a bit of a honeymoon period, I would argue, over perhaps the last 3 years in the oil field water space, where as it became increasingly apparent that some of the oil and gas producers were significantly economically challenged, even with crude around $50 a barrel, there was a lot of interest from the investor community in water because it was seen as something that got you exposure to oil and gas activity, but maybe without necessarily the same degree of immediate commodity price risk exposure that you would have if you're drilling oil and gas wells. And I think one of the realizations that is happening, very rapidly at the moment, and started with the, right around the time of the coronavirus epidemic, is if you're in a derivative business, your exposure to the commodity price may be cushioned a little bit by time, but ultimately you're you're almost as exposed in most cases, unless you have very special take or pay contract structures, you're almost as exposed as your E&P customers. And this is something I think that's likely to perhaps very significantly affect how portfolio capital views investments in the water midstream space moving forward. And I think we may be poised to move into a much different type of activity environment now than, I would have said if you asked me this question, for instance, back in August of 2019, when I first started speaking publicly about this hydrovascular grid issue. And I think also one of the dynamics that's going to be really critical in this is you start asking, okay, is this something that potentially pushes us more toward supersizing, where, maybe instead of a 16-inch diameter pipe being the norm, maybe we're moving to 24, 30, 36, and so forth. I think that one it's tough to answer conclusively at this point. I think there's a lot of uncertainty around it, because I think if you're just thinking in a very theoretical economic perspective, to the extent that you can consolidate into large backbone infrastructure, it likely is, it's probably going to be more efficient per barrel of water moved. But if you think about somebody's appetite for investing in these systems, given what's happened in the commodity markets over the last 2 to 3 years, and especially if they approach their system investment thinking, okay, I'd like to build this giant pipeline that, if you put me in the water stream with a air tank on, I could take a ride down it too. It may sound great initially, but then when you look at the water production profile of a lot of the wells feeding it, you realize that there's a huge upfront bump in about the first 12 to 15 months of the well's life, and then it rapidly tapers off. That is something that is likely going to be a lot less appealing, because what you may be seeing is, okay, I'm going to build in this huge peak capacity handling ability and lay out the capital for that. And then if oil falls to $30 a barrel or something in that range later, and drilling basically stops, I'm left with this large amount of unutilized headroom in the line. And so I think there's going to be some very significant questions that arise on this issue. Now, Todd, I'm getting a question here from a viewer. Is there any way that you're able to put up that deck of slides, or do you want me to do it from my end?
Let's see. I can try and do it.
Okay, yeah, because I can put it up from my end. If
Yeah,
that's...
why don't you do that then? Why don't you put it up from your end?
Okay, yeah. Let me just pull it up quickly here. But yes, and so, you know, as we look, and I think one of the other issues, and this is something I think is very likely to manifest itself more and more as we're moving forward, is I think as you're thinking about large consolidated water systems, especially on the Texas side, where all of the subsurface water, as a matter of law, is owned by the surface owner. I think one of the very challenging economic questions is figuring out how to make a system that transcends multiple tracts of land, but still preserves the types of economics that you need to make the system viable from the perspective of your E&P customers. And I think as you know, as we do this, it's going to be something that, you know, it's going to evolve as we go along with commodity prices. But, you know, I think this balance of some of the pre-existing dedication footprints, especially those, you know, that may go through a bankruptcy proceeding, and then imagining how systems may be developed going forward and how this interacts dynamically with where drilling is actually occurring. You know, there's going to be, I think, a more complicated set of balancing than maybe we would have had, you know, if you had raised this question, for instance, you know, even a year ago, much less 2 years ago. So I think I've shared my screen here. Are you able to see the slide deck?
I see you.
Okay, are you able to see the slides now?
Nope.
Okay, Todd, do you mind doing that from yours? Because
sure. Let me try.
Yeah, for some reason it's not displaying mine. So, you know, I'm trying to think here some of the other, you know, market evolutions here, because we've, you know, something I've gotten questions on in the past, and I suspect these may be replicated in the audience now, is, you know, how do you think about a hydrovascular grid and scaling up? You know, how does this factor in, you know, even in the price environment we had before, but certainly now, you know, is it really the answer to go towards a water super system, or are there, you know, actually areas and times when you can make a very strong case for smaller, more spread out systems? I think the short answer to that is there are going to be some areas where, if you have particularly drilling hotspots, and especially if some of those areas start to have more seismic issues, and what I'm speaking about is, for instance, what we've seen recently near Orla and Mentone, where we've started to see some fairly significant seismic activity. And those are some of the hottest drilling areas in the Delaware Basin. And those are areas that people seem very willing to drill, provided that you have oil prices north of, you know, maybe $40 a barrel. For a situation like that, the ability to move water further in a system and evacuate it to another area that maybe doesn't have the same seismicity challenges or disposal constraints, I think there's enormous value and enormous appeal in being able to do that. I think, for instance, if you're looking, and I think actually this also applies in the Southern Delaware Basin, where there are some very strong existing areas of production, and there's areas that, if oil prices were to recover, would become attractive for drilling again. And juxtapose against that, we've seen a lot of seismicity picked up by the TexNet network over the past few years. I think that would be another area where long distance evacuation likely makes more sense. I think there could be, other pockets of activity where maybe it makes more sense to keep the system a little bit more localized. And so I think there's going to be a strong case by case aspect. But I think the other factor that is one that, is going to influence both the thinking of a capital provider who may be backing a system, and I think may also be something that influences the thinking of an E&P operator if they're building a cell phone system, is you're generally going to have a cost curve of sorts where some of your disposal wells will be a bit more cost efficient than others. You sort of think of what a cost curve looks like in a typical commodity market. And at the end of the day, that concept is likely to apply to disposal capacity as well. And so if you have the ability, especially in a water network that, at a given time may not be utilized at full capacity, being able to wheel that water and emphasize filling your cheapest, your lowest disposal cost wells on the network, I think is something it's very desirable if you're a company operating your own proprietary system, because it helps you keep your lease operating expenditure down. And it's something if you're a third-party commercial provider of water disposal services, it's obviously ideal there as well, because you're able to boost your margins. And instead of having to go to the well that costs you 25 cents a barrel, if you're able to wheel that water to wells that cost 10 or 15 cents, and maybe even in some cases, if you're interconnected with your competitors, or maybe competitors isn't the right word, some of your neighbors who also have a water system, and they have a well that's lower operating costs than yours and is not being fully utilized, you may be able to actually switch water over to there and find some way to split the economic upside with them, for instance. It opens, basically, I think what the bottom line, and this is one of the intellectual fibers that I think really undergirds this whole concept, is better physical infrastructure connectivity unleashes human ingenuity in the commodity markets. Because I think one of the challenges is, if you don't have the infrastructure connectivity, you can have the best ideas on the face of the earth, and it's really hard to actually execute on those. What I think of is, I can go look at a map from SourceWater or another vendor where you see different disposal rates and costs and things like that. But if you don't have the ability to physically move wet water between some of those assets, it really crimps your ability, and in some cases totally eliminates your ability to actually capitalize on those arbitrage opportunities. And water is not unique in this way. Every physical commodity market, especially ones that don't have a deep traded paper market, in where it's more of a specialty commodity, you think of some of the metals, cobalt or lithium or something like that. Water, I think, in some ways is more in that grouping, where you really do need the physical connectivity to make things happen. And the physical connectivity, I think, is doubly critical because water is also unique as a commodity, because you look at how much it costs to move at a given distance as a percentage of the actual value of the water. And I'll give you an example. Some of the numbers, and these were numbers I ran last year, so the prices have obviously changed a little bit, but the relationship still broadly holds. And I looked at that point in time how much it costs to move a barrel of crude oil from Midland down to the Gulf Coast as a percentage of the underlying commodity price. And under a lot of circumstances, you're looking at the neighborhood of 5 or 6%, sometimes a little bit more. If you were to go to a somewhat more extreme example, and for this I used soybeans that are trucked from the Amazon region of Brazil and Mato Grosso, which is one of the main growing areas, to ports near Sao Paulo over almost 2,000 kilometers of road, it was about a third of the commodity's underlying market value is what it costs to actually get it to a market. For water, the example I used was the Vista Ridge pipeline that's bringing fresh water from Burleson County in East Central Texas down into the San Antonio area. And the cost to bring that water was 300% of what the water's stated price actually was in the purchase agreement between the city and the operator of the well field. And so when you have one of these commodities where you have this disproportionately unfavorable relationship between the value per unit and what it costs to move it, then having those pipes in question is, it's really critical. Yes, Todd.
Can you see the slides?
I just see the cover slide. Let me try one more time to share because I'm getting another question here.
You can just tell me when to advance if you'd like, and I will advance it for you.
Okay. So can you if you want to go ahead and flip forward. Now, and this is in response to one of the questions here, advancing to the slide I'm discussing. I'm actually not tied to a specific slide, but Todd, if you want to start rolling forward through the slides, I'll tell you when to stop here. If you want to, I would roll forward probably 6 slides from where we are now, if you're able to do that. I'm not seeing them. I may not be able to see the same screen as the audience here. I don't.
So you're not seeing any slides?
I just see a cover and I'm not seeing it move. Let me try one more time to actually share it from mine here. Yeah, let me
Okay, I see it.
Okay, do you see it there?
Yeah.
Yeah, let me roll forward a little bit here. I think we've already talked about, quite a few of these things. I think one here, and I think this is one, we've hit on a lot of these reasons. I think maybe at this juncture, sharing some of the actual geospatial images with the audience will help, kind of bring some of these things home. And, this map here, what you're basically looking at is the northern Delaware Basin, and you can see the various spaghetti strings of pipe here. I'm realizing that I'm not a great artist in terms of choosing colors, but what you see is you have some very large systems, and in some cases they literally will actually run on top of each other. And in one instance, when you look at some of the NGL system, that actually incorporates a lot of pipeline that Mesquite SWD owned before. And so there's already been a consolidation there where you had 2 systems that very naturally dovetailed together, and lo and behold, you had M&A activity, and now they've been consolidated. I think there's still a lot of additional upside for that to happen. I think if we're thinking positively about reasons for this to happen, I don't need to read the slide to you here. I think it's, it really opens up a lot of logistical and trade opportunities. But I think one of the areas that is also going to be challenging here, and I think it's one that maybe is not as frequently discussed because, we don't like talking about money and who gets paid what in some instances and so forth, but I think it may be some of the bid-ask expectations on the parts, among others, of some of the sponsors of these systems, where let's say that you invested in 2018 or maybe even early 2019 in putting together a water infrastructure footprint, and you're expecting a certain rate of return on your capital, and maybe you expect in 3 years or 4 years or some time frame therein to be able to turn around and sell your asset footprint for 2.5 times the capital you invested in it. Well, the problem now is the world obviously has just changed very dramatically. And so if you're the type of investor who is fine being in the water business for 8 or 10 years to get your returns, and really digging in and operating and just accepting that your compensation is going to come through distributions as opposed to a sale of the entire system or footprint, it's something that I think is easier to adapt to. But if you have a New York or Chicago or San Francisco based investor that thought this was going to be 36 months, build things up, get dedications, and then turn around and sell it and move on to the next investment item, that's something that is much less likely to happen now. And I suspect there's some tough conversations going on, because not only do you have shattered expectations of being able to sell in a certain time frame, but now you may be looking at potentially opportunities for putting together different sets of pipe, where if you're the company in the stronger financial position, you may see this as a great buying opportunity. And if you're the company who's in the position that's weaker, but you're not yet on the steps of the bankruptcy courthouse, there may be some really strong back and forth trying to get that bid-ask spread narrowed, because let's just say for round number purposes, you thought your asset was worth 250 million and now it's actually worth 100 or 150 based on market conditions, but you still want something close to 250, and your buyer says, okay, I'll give you 110. Well, we still have a giant gap that we've got to narrow down. And so I think one of the big things that will influence this, I think if we see oil prices recover back into the 40-ish range relatively quickly, people will probably be more inclined to hang on. And I think the consolidation may not unfold quite as rapidly. I think if we see something where prices were to stay, lower for longer in a very severe sense, perhaps, especially people are willing to accept some degree of write-downs on what they may have initially put into the system, you may see this happen much more rapidly. But I think just like many other things that we're seeing in this environment, there's a huge amount of uncertainty around that. And, I think it'd be foolish and hubristic to try to, definitively predict one way or the other. I think, the way I'm looking at this now is, what are some of the frameworks maybe that we use to anticipate how things might move structurally under different types of conditions that I think we could plausibly see over the next 6, 12, or 18 months. So we're getting a question here from the audience. The pipeline highlighted in red, that one is actually not a pipeline. That's a tract boundary for Winkler Services. It's not reflected in the map legend, but that was a legacy of a map I had made before. So that's not actually a pipeline, in case you're wondering why you have this really contorted shape there. It's actually a tract of land that somebody sells water off of. So I'm going to roll forward a few slides here. Okay, so, let's quantify. I've made a lot of statements here so far about optimizing capital expenditures. And so this jagged peak number, this is actually slightly dated. I believe the number is closer to $90 million is what they spent before, in cumulatively, before they were acquired by Parsley. And you look at how their system is, in some cases, you have assets that are almost a stone throw from things operated by Felix Water, which itself has built a very formidable system. And Felix does not disclose, to my awareness, what they've spent. But if you just apply some reasonable estimates, what you start to see here is these two entities that, for a fair amount of their system footprint are almost on top of each other, have spent, in the neighborhood of $250 million putting all these asset footprints together. And I'm certainly in a position where hindsight is 2020, and they could very fairly accuse me of, enjoying the talk is cheap position because I was not in their seat and I didn't have to invest in anticipation of a certain drilling and completion program and so forth. And those are criticisms I would completely accept. But I think that notwithstanding, when we just look at that system footprint there, I think it does provide a very graphic illustration of some of the economic upsides that frankly can be reaped through the construction and the expansion of a more grid-like system where you no longer necessarily have to think about water as something that occurs within, say, 5 miles of your well pad, maybe as if the basin, continues to see this kind of consolidation activity and some of the infrastructure linking systems, maybe you start to think of water as something that occurs within 10 miles, within 15 miles, maybe even one day within 25 or more miles of your pad, if produced water does indeed become a more fungible commodity, especially, in areas like parts of the Delaware Basin where we see a lot of drilling. It's hard to fully foresee where that goes, but you can certainly imagine, if you're constrained to basically a few sections around your well pad in most cases, you're looking at the world through a fairly narrow tube. If you can suddenly look at the world through a 30-inch pipeline that you're able to tap into that connects several different areas of high activity, that really opens a lot of doors. And especially when we see the creative, deal making and structuring that already has happened to date in the water space. My basic mental framework that I approach the sector with is I'm very much a technology optimist, and I'm also an infrastructure optimist in the sense of, if you take a bunch of operators and water midstream people and landowners and others out there and you start to create large gauge infrastructure, my general operating assumption is that they'll find ways to use it that are roughly in line with what we think about today and what we anticipate today. But there's a pretty good likelihood that they're also going to find ways to leverage and utilize that infrastructure that maybe we're not thinking of today, that actually yield real benefits, both in terms of enabling people to produce oil and gas at a lower cost, at least insofar as water handling is concerned, but also where we start to open up secondary opportunities and hopefully turn produced water into a resource that actually transcends the boundaries of oil field activity alone. I think this is something that, broadly we still, we're gradually moving out of the theoretical stage, but there's still a lot of challenges there. But the way I think about this as a native West Texan is every barrel of produced water that we can use, not just for reuse in fracs, but maybe even for something outside of the oil field, for cooling power plants, for irrigating saline, salt resistant crops at some point down the road, non-food crops, things like that. Every barrel of water that you use that came from the oil field generally will displace a barrel of fresh water that then either can be banked for the future or can be used for another purpose. And I think generally speaking, that's something that is intensely beneficial in a region that, has been dry for as long as it's, been inhabited, and certainly for, the entire industrial area. So I think there's benefits that, very much go beyond, some of the traditional balance sheet, concerns that we often will talk about when we're discussing some of these oil field water issues. Now, not going to dwell on utilization rates because I think a lot of the discussion we just had on optimization of capital expenditures very much encapsulates and subsumes a lot of that discussion. One of the things I think that very much merits conversation at this point, and this is a slide that I originally constructed last year when, if you would have asked me, would oil prices break zero for a day in the Permian Basin, I probably would have chuckled a little bit and said, that's an interesting scenario, but I think it's insane. Well, now we're there and it's happened. And I think it's therefore very interesting at this point to look at where we are so far in terms of parties who are deploying capital in the oil field water business and how this might evolve, under some of the longstanding structural trends that we see, and also, frankly, how it may evolve in light of some of the more unexpected things that have happened over the last couple of months here. And if you look at the traditional oil field water development model, it was very localized. It tended to be mom and pop saltwater disposal wells. These were typically things that you would fund out of the friends and family network. If you're out in Midland or somewhere like that, you may find some, in some cases, very substantially sized local capital pools and investors who would like to get involved in projects like this. And I think that's really how the business got started. We started to see some of the more risk-embracing private equity firms enter the space subsequently to that. And that's when you begin to see some of these teams that we see now. You think of the Goodnights and the Solarises and some of the other oil field water logistics and some of the others where you have management teams in many cases who had decades of oil and gas midstream experience and deep engineering and geological and financial and operational backgrounds come in, and you really start to professionalize the water management space. But it's still something that the risk profiles may be a little bit high for direct investment by some of the larger capital pools. I think pre-coronavirus, we started to see larger entities get involved. And I think especially if we think about maybe the 6 or so months before the coronavirus pandemic really hit in North America, we started to see some of the really large capital pools, including pension managers, actually consider much more direct involvement in these assets. And I think that was a very interesting development because you think about this idea of a strategic midstream consolidator that can come from a large pension fund, from a sovereign wealth fund. It could also take the form of a Kinder Morgan or an Energy Transfer Partners or an outfit like that if they were to see it as an opportunity that could deliver sufficient returns to compete with some of the other investments that they're probably considering in their capital portfolio. And I think this is a huge development because I think when you start thinking about these types of capital pools becoming involved, your logical next step, if you're thinking about, okay, as water evolves from kind of a risk play to an intermediate consolidation play to something that's maybe a more mature utility or even real estate investment trust type of play, it's a whole different suite of investors. And you think about the ultimate exit opportunities for those, maybe even culminates in an IPO and going on the public markets. That is something in my mind that I think we're a long way from. I think during 2018, there were some entities that explored the IPO market and ended up opting instead for a large private capital infusion. I think in the wake of what has gone on recently, I think an IPO or public markets liquidation event is monetization event. I think that's something that's much further in the future. I think it's hard to even put a timetable on it now, but I think the shifting in investor profile is, something that's very much worth watching. And I think one of the other things that's going to be interesting to watch as the investor profile shifts is, I think one of the things that maybe wasn't a point of emphasis early in the evolution of the water midstream business that is much more of a focal point now is the ESG side of things, the environmental, social governance side of the ledger, because you're starting to confront issues of potentially being able to displace fresh water if you're using greater amounts of produced water, which I think is a positive. I think another positive item that people will be considering is it potentially effectively helps you decarbonize the sector a little bit. And what I mean by this is, if you look at the old model where a lot of the water volumes were trucked, or even if the water volumes are maybe being moved through a pipe, but it's something that is on a more ad hoc basis, and instead of an electrical pump, you have a diesel generator set or a diesel powered pump, it's still fairly emissions intensive to move each barrel of water. Let's say that you're going to a large bore pipeline, you bring in grid power, you put in efficient electrical motors to move that water, and you're literally taking cumulatively hundreds of thousands of truckloads, if not much more than that, per year off of the roads just in single parts of the Permian Basin. You're starting to have an enormous positive impact there on emissions, on diesel fuel use, enormous impacts on road safety as well. I think this is sometimes a relationship that, when we talk about the hydrovascular grid, is maybe sometimes not necessarily focused on, but data that we ran back in 2018 showed that the road death rate per 100,000 people in the core counties of the Permian Basin was on par with the road death rate per 100,000 people in Russia. And for any of you who want some decompression entertainment, you should go on YouTube at some point and Google driving in Russia, and you'll see why this comparison really matters. It's just an absolute madhouse on the roads there. And yet the death rate that we had in our own Permian Basin here was just as high. And so when you think about a lot of that at some level being attributable to truck traffic and all the various driving pathologies that flow from truck traffic, you make a contribution there. You also make a contribution to local budgets by reducing the road repair cost burden and things like that. So, I don't want to overpitch the ESG end of things. I think there's a few of the midstream teams that verge on overemphasizing ESG, because I think at the end of the day, capital is still going to come to the sector primarily driven by the expectation of a certain rate of economic return. But I think when you're able to have some of these very compelling and very empirically supported ESG stories come in alongside the potential for extracting oil and gas at a lower cost and more efficiently, I think that it creates one of these rare situations where you can potentially make green by being green. And those opportunities are not necessarily common in the oil field. And so to the extent that those can be capitalized on, I think it's very welcome. And it's frankly something that's in the broader public interest. So some of these things we've already gone over here, so I'm not gonna dwell on those. I think some of the key challenges for the grid, I think a lot of what I've been talking about here has fundamentally been sort of a story that's oriented toward the pros column as opposed to, I wouldn't necessarily call it the cons column, but maybe the challenges column. And, I think some of these are issues that the operators in the space have already become very good at sorting out. Construction challenges, for instance. Over the last couple of years, you have long lead times to get materials. It's sometimes challenging to get permits. It's challenging to get right-of-way permission from landowners, because unlike an oil and gas pipeline, you don't have eminent domain power when you're building an oil field water line. And so you have a lot of very interesting negotiations that have to occur. But I think those, in most cases, are tactical challenges that the operators have adapted to and have been able to overcome pretty effectively. I think commodity prices, we've already talked about the idea that water services providers, including water midstream pipeline operators, really are long dated crude oil and natural gas traders. I think this was something that people were aware of, but maybe didn't want to think about as much, in 2018 and 2019. I think it's going to be much more at the forefront of conversations now. I think also in this environment, you're going to have E&P companies really thinking not only about their water costs in operational terms, but they're also, I think you'll see a bit more consideration of people, of managements thinking about actually selling and monetizing their water systems and selling dedications along with that. And I think you have some very interesting issues that arise out of this, because one is, if you have investors rebasing their expectations of returns and also rebasing the types of transaction structures that they want, you may not necessarily have, you think about some of the transactions we saw in late 2018 where, among others, you think of Halcone Resources selling its water system to WaterBridge and getting paid $200 million in cash, plus large, contingent earning potential alongside of that. Those types of transactions may be harder to do now. And I suspect if we see more system sales, there may be structures that require the different entities to keep a little bit more long-term skin in the game. For instance, instead of a water midstream operator paying cent a million amount of cash for a water system, maybe they give them a larger equity stake in some type of joint venture, or even in the midstream company itself, where the E&P company is able to offload its capital expenditure burdens, it's able to offload some of the operational risk, but in terms of actually realizing a more direct financial return from doing that, they may end up having to do it in a way that's a little more closely aligned with the risk profile of the water midstream company. And I think this will be something that'll be very interesting to watch over the next few quarters here. I think regulatory risks, that's going to be a very interesting area, because we are seeing more seismicity crop up, especially in the Delaware Basin. And I think one of the things that, is going to have to be worked out scientifically is how much of this is a true net increase and how much of this is an increase in seismic activity that we perceive because there's actually more monitoring equipment out in the area now. My personal suspicion is it's probably a bit of both going on, but I think homing in on that is going to be very important. And I think one of the other regulatory risk factors is, amidst discussions on seismicity and flaring and some of these other oil field externalities, we have a very contested, or what looks to be a very contested, Railroad Commission election coming up this fall, where we won't have commissioners sitting anymore. And, there's a very real chance that we could see a partisan split where you have, not only a mix of Republicans and Democrats on the commission, but you also have significant geographic dispersion where you'll have Commissioner Craddock from out in the producing area, and then you'll have other commissioners who are from the Texas Triangle and places that benefit directly and indirectly in economic terms from what goes on in the Permian Basin, but aren't necessarily as viscerally tied either to the cost or the benefit as those who live and work and invest in the region. And so I think, there may be some very interesting political things that happen that, haven't happened for quite a while, here in Texas. I think pricing the water is going to be a huge issue. I think if we imagine a future where an oil company has to operate as an enterprise that can survive and generate free cash flow at oil prices of less than 50 a barrel, perhaps less than 40 a barrel, depending on what Wall Street demands in order to treat them as a desirable investment target, you could see some real restructurings in how oil and gas extraction operations occur that are obviously going to have very direct and substantial impacts on the water midstream space. Let's say, for instance, that water midstream company X has 100,000 acre dedication, and they assumed when they purchased that dedication and negotiated for it with the oil and gas producer that that producer was going to be drilling its wells spaced 440 feet or 660 feet apart. And let's say in this new oil price environment and with greater understanding of parent-child well interactions and some of these other factors, that now the wells are spaced at 880 or 1440 or some other larger interval like that, so you have less wells per acre of dedication. That's a dramatic change to your expectations and to how you approach that in investment and operational terms. And if it's something you've already paid the money for, you're stuck with it at some level, and you have to figure out either how to make it work, or if it just can't work, you face the prospect of some type of restructuring that's likely to be painful and unpleasant. But if you're somebody who's looking at the sector now, these will be thought processes that maybe get factored into a much greater degree than they would have, even 6 or 12 months ago. And then I think one of the other issues that's going to be a gigantic challenge is how potentially does rent sharing occur with landowners if you're building these larger consolidated systems, in particular if landowners are asserting some type of ownership right to the water and because they see value being extracted from it and demanding compensation. I think this is an issue that we're just now starting to see emerge, and it's one that I think is also going to be worth watching because it'll have potentially profound effects, I think positive or potentially also negative, on system economics and on the ability to build some of these large consolidated water systems.
Gabe, just a
yes.
question for you.
Yes.
And well, actually, let me just make an announcement. So I unmuted all participants some time ago. So theoretically, you can unmute and ask a question if you like, or you can type it in under the Q&A. We've had 3 so far. I wanted to ask you a question. You were talking about, regulatory issues. Now, I understand that the Railroad Commission, maybe last week, relaxed the rules for storing excess oil underground. And my question there is, if they're going to be, if producers can be able to store it in places that they haven't been storing it before, who's tracking that? Is the Railroad Commission tracking that, or the groundwater conservation districts where they exist? Are they supposed to track that? Who will be responsible for knowing where the excess oil is being placed?
That one, I do not know conclusively. I'm not as familiar with the oil side as I am with the water side. I mean, if I were sitting at a groundwater district and wanted a sense of that, or any other entity for that matter, probably my first move, assuming that there has to be some type of permission still given by the Railroad Commission for that type of storage activity, frankly, would probably be to make a public information request and see what types of permissions or permits the Railroad Commission has issued for that, because generally those you'll be able to ascertain the geographic area. And so if I were worried about that in my area of jurisdiction, I think that would be, probably one of my first moves. So I could start to, get a handle on what's going on there. And I think you would also have to potentially accept the limitation that with some of these storage moves, things are happening very quickly now. And so, and potentially in some areas at a fairly large and dispersed scale. So you'd have the challenge of A, getting the data. And then I think B is, if you're concerned about protection of water resources and other such things, is you potentially also have the inspection and enforcement questions. Figuring out where everything is just step one, and figuring out how to actually monitor it, I think that's sort of steps 2, 3, and 4, and those are potentially much more challenging. Now that the audience members are unmuted, if anybody has questions, I know I've talked for quite some time here. And so, to the extent that anyone has questions, whether you want to ask it on open mic or whether you want to type it, I'd be very happy to take some of those, given that we have about 15 minutes left at this point.
Well, I have a question while people are thinking about questions they might like to ask.
Definitely.
So, where do you see oil prices going? You're an economist. What do you think is going to be the impact on the state budget here over the next year or two? I mean, we've got a legislative session starting in January, and the looking at your crystal ball, the situation that the legislature is going to face when they reconvene is much different than what they thought just a few months ago.
Mm-hmm. So I guess I'll preface this question by saying my crystal ball's been dropped a couple times, is probably a little bit scratched and chipped, and so take what I say certainly with a ample grain of salt. What I would say in terms of where oil prices are likely to go, price prediction is generally pure folly. That said, I'm happy to talk about directional trends. And I think one of the discussion items that gets lost amidst the disruption of the coronavirus pandemic is that the fundamental position of oil in our modern global economy is not going to be erased by the virus. And you already see this, even the weekly demand and product supply data that you see from the U.S. Energy Information Administration. It'll probably come out in about another hour. One of the things you notice when you chart that data is the oil products that are directly used by consumers have gotten jackhammered in terms of demand. This is gasoline and this is jet fuel. Middle distillate, which transports all of our goods and that the Amazon delivery truck runs on, and the trucks bringing food to the grocery store, has actually been, I think, more stable and stayed higher than probably would have commonly been anticipated. And so I think what you see is, even in the midst of one of the biggest crises that we've faced in many years, oil demand is still pretty sticky. And, one of the big things that we have to think about is oil burning assets have a long life. I think we confront this when we talk about coal and power plants where, for instance, if we're worried about emissions in China, in India today, there's a lot of concern because you build a coal plant and it's online for 40 years. I think what's sometimes less appreciated is a lot of the smaller oil burning platforms will stay operating for a long time. I mean, I don't think it's uncommon at all for cars and trucks to have an ultimate service life from first point of sale until they hit the scrapyard, of 20 years, give or take. You're looking at semi trucks and heavy equipment and things like that. The lifespan can be even longer. And then you go to airplanes and ships and some of the other major, transport platforms that are very oil intensive. Those will sometimes be in operation for 30 or 40 years. And so I think, everything that's in the fleet now and that continues to be sold into the fleet, even amidst the epidemic, that's demand that's probably baked in for the next couple of decades in many cases. And so this isn't to say that oil demand is going to rocket to some new high after the coronavirus pandemic. I don't think it will. I think in some areas like air travel, if you look at historical examples like the effect that the 9/11 attacks, which was another fear-driven event, had on passenger travel in airplanes, those effects lingered for 3 to 4 years. I think it's entirely reasonable to expect a similar scenario with the coronavirus. And so, you know, when we're talking about an oil market where marginal movements on the supply and demand side of 1 or 2% can have profound price impacts, I haven't looked at the latest forward price curve, but, I think something, where we're kind of operating in a band, before the band was expected to be maybe $50 to $65 per barrel, undulating over time. I do think that moves structurally lower in the wake of the coronavirus when you see the impacts to jet fuel and other types of activity. So, Todd, I'm actually going to shift here. We're getting some more questions coming in here. I'm gonna try to address these sequentially. So we're getting a question here: how to think about differences in water administration across the state line, and I suspect this is geared toward the Texas-New Mexico state line, where the invisible political border, divides two dramatically different water universes in terms of how water is treated in legal terms. I think it's going to depend which direction the water is flowing. I'll also talk about the factors that will influence the direction of that flow. If you're thinking about fresh water, taking any type of reasonably potable water and exporting it to Texas would be a total non-starter. Bringing potable water in from Texas into New Mexico, I think previously in pure legal terms, I don't think there was much that New Mexico was really able to do to slow that flow if somebody saw it as being in their economic interest to bring that water. I do think we may see that change with the New Mexico Produced Water Act and its strong encouragement of the recycling and reuse of produced water. So I think on the freshwater side, what's happened legally in New Mexico during the last legislative session is going to reverberate into some of the, areas in Texas from which freshwater was previously being sold into fracking markets in Lee and Eddy County. As far as produced water, I think that's generally going to be a southbound flow. And I think the reason for that is what we see from the authorities in New Mexico is a very strong reluctance to issue any more Delaware interval disposal permits. I think this is driven both by the authorities, and I think there's also oil and gas operators in Southeast New Mexico that have concerns about wells being watered out if there's migration from the Delaware Mountain Group into potentially oil and gas bearing intervals such as the Avalon Shale. So I think, and you're going to get protested if you seek one of those permits. And so I think when you face the choice of either drilling a deep Devonian well, which is much more complex and expensive to dispose of your water, or sending it southbound where you have landowners on the Texas side that for the right fee are very happy at this point still to see Delaware Mountain disposal wells put in on their lands. I think that southbound flow, as long as there's activity in New Mexico sufficient to generate more water than the local SWD systems can handle, I think you'll still see that southbound flow. Now, I'm going to move to another one here. When we think of water grids in some other geographies outside of the Permian Basin, you think about, okay, what kind of role does government have? Do we need big anchor customers to effectively underwrite the capital and operational costs of the system? And how might some of the big public land entities in Texas, such as university lands, factor into this or drive this? I think it remains to be seen. I think these entities, whether you're looking at university lands or the general land office, they definitely want to monetize the water activity that is occurring on their land. As far as a more interconnected grid system, I don't know what GLO's attitude would be. University lands, I'm a little bit pessimistic. And the reason for that is when I look at the changes they've made over the last year or so, where they've started actually imposing a crossing fee on water that moves across their land if it didn't originate from under their land. What that would seem to suggest to me is that the desire to monetize trumps a desire to build necessarily a more interconnected system. And I don't think I think it's an entirely rational economic decision to want to make sure you protect what's within your boundaries. And I think with a lot of private landowners, we see a similar approach. And I think this is going to be one of the biggest challenges, frankly, that we'll have to overcome if we are going to see bigger, more interconnected grid systems, especially for new construction. If you already have existing assets that can be grandfathered in and you're maybe able to sidestep some of these issues, I think that's great. Maybe those will actually be some of the backbones for what we see, emerge. But I think this dynamic of, intense self-interest on the part of public or private landowners, I'm optimistic, and I think there's ways with creative contract structures and others to potentially overcome this, but it's not going to be easy. So I think we have a more technical question here. How important is remote monitoring of produced water from an operator's point of view for day-to-day operations? I'm not in an operational position, so that I think inherently limits my ability to comment on some of this in a intelligent way. But what I would say from some of the midstream operations I have seen is they very intensively track activity through their SCADA systems. And I suspect that the E&P operators that are, running their own systems, I mean, I've seen, published SP articles, for instance, from engineers at Cimarex, where if you look at what's being portrayed in the article, they very clearly have an extremely good handle on the pulse, I think, of what's going on in terms of flows and pressures and such within their system. And so I think it's something that, behavior would appear to indicate is very important to them. They seem to have become very technically competent in many cases at doing it. And if we're tying this back into the broader hydrovascular grid concept, I think that's something that's very positive, because if you have that type of information visibility, it starts to really facilitate your ability to move and manage these systems in conjunction with each other. You kind of think how the power grid works. Water is obviously different because electrons move at the speed of light, just like that. Water, it's a slower, big physical molecule, but I think some of the basic concepts are crossed over.
Okay, well, we have a few minutes left. Any other questions that anyone wants to ask? Go ahead and type them in here quickly if you could. Gabe, any other thoughts? Oh, here's one. Just popped up right now.
Okay, so beyond the oil field, beneficial reuse of produced water. I think there's a couple of big challenges here. I think the first challenge, depending on what you want to use that water for, is just simply the physical reality of whatever that end user market is. Like I'll use plants as an example, and you'll see a deeper discussion of this in my journal piece that I published with the Texas Water Journal earlier this year. One of the things that researchers have found with certain grain crops is it seems like there's certain components in produced water streams, they suspect it may be boron and other, trace ions like that, can actually adversely affect plant health and yields. So I think overcoming some of these more technical and scientific challenges will be important. I think the other challenge that will be enormous is legal liability. I mean, I think of some of my brethren in the plaintiff's bar, and some of the interesting cases they might bring if, say, 5 years from now, people start who had consumed a crop that was watered with cleaned up produced water, or had worn shirts and clothing made out of cotton that was irrigated with produced water, some type of scenario like that, suddenly started developing a health condition of sorts. You could imagine what plaintiffs' lawyers might try to do with that. And so I think there have to be some really deep public policy discussions in terms of, would legislatures, for instance, consider various indemnities for somebody who is repurposing water, maybe various, litigation safe harbors and things like that. But I think you can't really have that discussion in a useful and educated way until you've done a lot more science. And, I think when you look at some of the environmental NGOs, you think of Environmental Defense Fund and others, they've really been pushing hard on this idea that we need to do a lot more science in what's actually in produced water. I think that's very true. I mean, I think ultimately we'll need some of these different, indemnities, safe harbors, and other things to incentivize certain uses of produced water beyond the oil field. But I think before you go there and before you take legislative action, you need as deep of a scientific understanding as you can reasonably acquire. And this, frankly, is one of the things I'm concerned about with our upcoming Texas legislative session. Is some of the events I've been to where very senior legislators spoke, it seemed like there was a desire to move extremely fast on reuse and potentially even repurposing of produced water for beyond the oil field uses, but without a commensurate amount of emphasis on the science that's necessary to understand what's in that water. And I think that's a gigantic problem. And I think this is an issue we're going to have to really, focus on from various angles, over the next 12 months or so. So if there's no other questions there, I very much appreciate all of you, taking this slice of time to share with us. Great questions. I hope that we were able to bring something interesting and something new to you as well. And if anyone is interested in, seeing some of the materials we published, or, continuing discussion and dialogue on these issues, I'd be very happy to, engage with you personally as well, and talk through those things. And, just once again, thank you for taking the time to spend with us here.
Gabe, thanks for being with us today and talking about your research and your work. I did get a question about sharing your slides, and was going to send those out to the participants at some point.
Absolutely. And this stems from a presentation I originally gave, in my official position at the Baker Institute. And so you can find them there as well. And I'm happy to also repost them on LinkedIn after this for anybody who's interested in going and downloading them. But yeah, it's all openly and freely available.
And the journal article that we published, your journal article is, of course, also free and available on texaswaterjournal.org. It was, I think, published in February. And also when you registered for the webinar today, there was a link to it as well. But if anyone has any trouble finding that, just send me an email, todd@texaswaterjournal.org, and I'd be happy to forward that to you. So thanks, Gabe. Appreciate it. And we'll have you back sometime.
Well, thank you. Appreciate everyone's time, and stay safe and have a great day.
You too. Bye-bye.
Bye-bye.